In this video, we want to talk about inventory, or what is sometimes referred to as a merchandise inventory. In previous chapters, we talked about a service company, a merchandising company, and a manufacturing company. And so what we're going to do is we're going to talk about inventory mostly from the merchandising standpoint. Companies that buy items and then resell items. So for example, Barnes & Noble buys books and then sells those books. Walmart buys a whole bunch of various items and then sells those items. And so usually those companies buy for, let's say, $1 and then they sell for $1.10, $1.20, $2. So they buy for one price and then they sell for a larger price. So the process or the cycle for inventory begins with purchasing items. So you purchase items, so one entity, Walmart, Target, Barnes & Nobles, they purchase items for the purpose of reselling. So, right, in order for something to be inventory, the item must be purchased for with the intention of either being resold or used in the final product. So when Barnes & Nobles buys a book, the goal is to sell that book. When Target and Walmart buy food or canned goods or various items, clothing, cleaning supplies, their purpose is to resell those things. But you also have manufacturing companies that buys like screws and plastic, and then they apply labor to those items and then they sell those. But when you buy items with the purpose of reselling those items, then those items are considered inventory. So when you purchase the items, they go into inventory, and inventory is on the balance sheet as a current asset, okay? So please remember that. So inventory is a balance sheet item. So on the balance sheet, there's this line item for inventory, and that represents the cost of items purchased for reselling. And I really want you to make sure you understand that. The cost of items purchased that will be resold, right? So when you buy these items, you buy them at a price and then you're going to sell them later on the balance sheet, okay? So when you purchase those items, they go into inventory on the balance sheet as a current asset. And then what happens is you sell those items, and when you sell them, they move from inventory to this account called cost of goods sold on the income statement, and cost of goods sold is an expense account. Right, so we see this flow. We purchase the items, those items go into inventory on the balance sheet. And then when you sell those items, they go from inventory on the balance sheet to an expense on the income statement. And we saw these with our adjusting entries, right? You would buy insurance, and it would be prepaid insurance on the balance sheet as an asset. And then when you use up those insurance, it'd be your insurance expense on the income statement. Supplies. When you buy supplies, it would be supplies on the balance sheet, and then when you use up the supplies, it would be supplies expense on the income statement. Inventory is very similar. When you purchase the items to be resold, that's inventory that you put on the balance sheet, and then when you sell those items, they move from inventory to cost of goods sold. So there's the direct relationship between inventory and cost of goods sold. Now, this idea of purchasing items to be resold is very, very important, because if a company purchases items without the intention of being resold, then that's not an inventory item. So for example, Walmart can buy pens and pencils and then sell that to consumer. But Walmart uses pens and pencils itself. So when Walmart buys pens and pencils for its own use, for its own employees to write with, that's not inventory, that's supplies. But when Walmart buys pens and pencils and then sells those pens and pencils, that's what makes it inventory. So inventory is items that you buy with the intention to be resold. At first, when you purchase them, they land on the balance sheet, and then once they're sold, they go as an expense on the income statement in this line item called cost of goods sold. And when you think about inventory, the other thing to think about with inventory is inventory deals with cost, right? Inventory deals with cost. So you're going to put this on the balance sheet at whatever your cost was. So if it cost me $10 to purchase these items, I'm going to list it on the balance sheet at $10. And then when I sell these items, it moves to cost of goods sold. And what the cost of goods sold tells me is the items that I sold, what was my cost for those items? And in the scenario we used, it's $10. So when you think about inventory, think about what was the cost of these items for the entity that purchased them.